You've seen this shape before, two value zones with a gap between them from the B-shaped video. Today, we are going to zoom into that gap specifically. It has a name, low volume node, and it's one of the most useful, most misunderstood things you can mark on a chart. A low volume node is a price area with very little volume traded. Look at the shape on screen, thick on top, thick at the bottom, and thin in the middle. Above and below, the market spent time. Many participants traded here, which means many participants agreed those prices were fair. That's the high volume node on either side. In the middle, almost no one transacted here. The market didn't pause there, it passed through. That's a low volume node. 3 stages, the same shape. You can see them numbered on screen. 1, 2, 3. One value gets established above, high volume, the market agrees on a range. 2, the price moves through the next area too quickly for anyone to transact. 3, value gets established again, below, high volume returns. That fast middle stage is what leaves behind the low volume node. Low volume there is not random. It means low agreement. Buyers and sellers did not spend time negotiating this price because no one wanted to be there. Here's the part most people get wrong. A low volume node is not a signal. When price comes back to retest, one of two things could happen. You can see them both on the screen. On the left is a rejection. Price dips in, finds nothing to hold it, and reverses the way back in, the same way it came. On the right side, we see a breakout. Price enters the low volume node and keeps going because there was never any value there to stop it. Same zone, opposite outcomes. The low volume node only tells you where price and where to pay attention to, not which of these two are coming. So how do you actually tell the difference? Order flow. This is a framework on the screen. The low volume node gives you location at the top, nothing more. What confirms the reaction is what you see happening right there in real time. The 4 boxes in the middle. Absorption, meaning size is quietly stepping in to hold the level. Imbalances, showing one side is clearly winning. Aggression, meaning traders are actively pushing, not just sitting on orders. And trapped traders, the people who entered on the wrong side of that fast move, who now have to get out. Put those 4 together and you get confirmation. The low volume node told you where to watch. Order flow tells you what's exactly happening and what's actually happening. And only then do you get to the bottom of this chart, the trade. So to recap, the 4 points on the screen. 1. A low volume node forms when price moves through a level too fast to build value. 2. Low volume there means low agreement between buyers and sellers. 3. When price returns, watch the reaction, rejection, or breakout. 4. Order flow, absorption, imbalance, aggression confirms which one you're actually looking at. A low volume node marks a location worth watching. It is not permission to act. Read the location, then read what's actually happening when price gets there. That's the difference between reacting to a shape and reacting to real market structure.